Good morning, everyone. It's Shauna, your tax goddess. Today, I want to talk about shareholder or partner loans. So this is a really interesting little section of the tax code. Well, I suppose all of the tax code is interesting to me, but specifically for business owners, because this can actually make a difference in how much of losses, if you have losses that you can deduct, as well as how your tax return has to be prepared by your CPA. Now, the first thing to note here, what is a shareholder or partner loan? So you'll notice I'm using two different words. Shareholder loans, typically you're going to go with a C.Corp or an S.Corp because those are shareholders. A partner loan is most typically going to go with a partnership. Now, the reason why that's important to know the difference between an S.Corp or a C.Corp loan and a partnership loan. Now, with an S.Corp or a C.Corp, those items may or may not give you something that's called basis in your tax return. So what that means is that if you've given money, so you've loaned money to the company or vice versa, the company has loaned money to you. If you've given money to the company, that may or may not cause shareholder basis. And in a partner loan, if you're the general partner, typically a loan in is going to give you basis. But if you're a passive partner, a loan may not give you basis. So there's quite a lot of technical details there, depending on whether you've given the money in, the company's loaned the money to you, what's happening. Now, in this particular video, what I really want to focus on is if the company has loaned money to you. Now, we get this question a ton when we're doing tax returns, often, most commonly in an S corporation scenario. What's happened is the owner of the company has taken distributions, and those distributions are above that basis level. They might be above retained earnings. Now, the problem with taking a loan above retained earnings is that that could mean that that loan, the money that you borrowed from the company, if you just take it as a distribution, you could actually be required to pay capital gains tax rates on that. Now, at the moment, those tax rates are not too terrible. They're not really high. I mean, they're 20% at the federal level and then whatever your state tax rate is. But we're expecting Biden's proposals to be passed for some of these new tax laws coming up here pretty quick in the next 30 days on or about September 30th. And if that occurs, that means capital gains tax rates could go as high as 28% plus whatever the state tax rates are. So you are looking at a significant amount of tax on taking your money out of your company. So what is the way around that? The way around that is to create a shareholder loan. It is a loan, which means over time you do have to repay it, but it allows you to use the current AFR, applicable federal rate, which at the moment the interest rates are super, super, super low. So that's a really good way to borrow money from the company to pay off debt or buy a new house or whatever it is that you need or want that money for. You do have favorable terms. You do have to have terms, okay? You can't just say, yeah, I'll pay back whenever, okay? But you could set up a 5-year term, a 15-year term, a 30-year term. You do have to, of course, make payments. You do need a document. You do actually need a promissory note or whatever the appropriate legal document is for your state. Now, we cannot do a tax return without having all of the proper documentation to back up the positions that you're taking in your books. So one of the things where business owners often question is, well, I mean, I've been doing this for years, borrowing money in and out of my company and moving cash around. Why all of a sudden do I need to have a shareholder note or a partner note? Now, it's not really an all of a sudden kind of thing. One of the things that we have been told at Tax Goddess is that we ask way more questions than any other CPA does. We do that because it is our job to be your fiduciary. It's our job to ensure that we are protecting you and making sure that you are getting the best of all possible worlds to protect yourself, get the best tax deductions, make sure that you're not going to pay that extra 20 or 28% capital gains rate tax. So that's a part of the reason why we ask for that documentation. Now, a couple of other things here about shareholder loans. So you have to have a note, right? You have to have some sort of documentation. You have to have an amortization table. So interest and terms and payments, you need to be making payments, okay? The minimum amount is $10,000. So if you were to borrow $9,500 from your company, it is not required to have a shareholder, an actual note and payments and all the rest of that on there. but anything 10,000 or more, you will be required to have those. Really, I think one of the biggest pieces that people miss is, fine, great, here's the document, I've set up the documents. Either they miss making the payments, which makes it all taxable, right? Because it's no longer a loan, or they miss filing the appropriate 1099s for interest paid, interest accrued, those kinds of things. So, guys, Tax Goddess tries to be as detailed as possible, especially when it comes to tax returns and making sure that you're covered. So if you have questions on what is the promissory note, what should it be in your case, what should those dollar amounts be, or for any of you that are not Tax Goddess clients, if you are looking at your tax return, and typically this is going to be on the balance sheet. Sounds odd this morning. Anyway, the balance sheet. Typically, it's going to be on the balance sheet. When you're looking at your tax return or looking in your QuickBooks file, if you see something called loan to shareholder or loan to partner or due to, due from partner, anything like that, those should have promissory notes. They should be properly reported. Yeah. I was about to launch into an entire separate discussion about related parties and loan notes. So let's do that really quickly. Depending on whether you're an S.Corp or C.Corp or a partnership, okay, a related party is somebody or some other company that you own more than a certain percentage. Now, you realize I'm leaving that very vague because in S.Corps it's one thing, in partnerships it's another thing. The rules for each are completely different. But if you have intercompany loans, if you own both companies 100%, for example, and the companies are loaning to each other, those may be considered shareholder loans or partner loans. If you own another company 50%, that may be considered a shareholder loan or a partner loan. So there are special rules for these related party loans that if you have multiple companies and you're loaning money back and forth, you absolutely need to make sure that your CPA and your team know those rules, are applying those rules, and are making sure that you are covered. So as a taxpayer, what can you be looking for as a client? Just look for on your balance sheet in either QuickBooks or in your tax return, a shareholder loan, a partner loan, a due to, due from, anywhere in your books where your bookkeeper is representing that you owe money to the company or the company owes money back to you, or intercompany between companies that you own. So I'm sorry for going into a little bit of detail, but really, guys, this is a tax strategy, even though it sounds like it's a bunch of paperwork. If you don't have the appropriate paperwork, so kind of like accountable plans, if you guys have seen me talk about those, if you don't have the appropriate paperwork, the IRS will not let you take the deduction. So this can cause some significant issues for you if there were ever to be an audit. All right, thanks so much, everyone. Hope you're having a great day, and we'll talk to you later. Bye.